All right, let's just dive right into this explainer. Today, we're demystifying a highly misunderstood world corporate entities that exist, well, pretty much entirely on paper. You constantly hear about them in the news, right? Usually next to buzzwords like scandal or tax haven. But setting the headlines aside for a second, the actual literal mechanics of how these entities work are just genuinely fascinating.
Now, to really understand why this matters, we have to look at the massive global stakes. Just consider this a staggering $1.3 billion. That is the amount in back taxes and penalties recouped globally since the infamous Panama Papers leak, according to tracking by the International Consortium of Investigative Journalists. And honestly, that figure almost certainly understates the true financial impact, mostly because a lot of governments just keep their recovered data completely under wraps. So, we'll structure our exploration today into four distinct phases. First, the billion-dollar paper trail. Second, shells, shelves, and SPACs. Third, legitimate business versus red flags. And finally, the global transparency crackdown. This is going to map exactly how these entities function and how global authorities are fighting back. Okay, Section 1, the billion-dollar paper trail. Let's start with the massive event that forced this shadowy financial underworld into the global spotlight. In 2016, the Panama Papers investigation dropped, and we are talking about over 11.5 million confidential documents, all leaked from just one single Panamanian law firm, Mossack Fonseca. It was a real game changer. It didn't just expose bad actors, it fundamentally changed how governments pursue revenue lost to tax evasion schemes. Virtually overnight, the offshore secrets of wealthy clients, executives, and even heads of state were completely laid bare for the world to see. And you can see the real-world financial impact right here. Specific nations suddenly recovered hundreds of millions of dollars that were previously just hidden away in the dark. Sweden alone clawed back over $237 million. France recovered over $208 million, and Spain over $175 million. This single massive data leak literally turbocharged a worldwide hunt for missing tax revenue.
Moving right along to Section 2, shelves, shelves, and SPACs. Now, this terminology gets thrown around interchangeably in the news, which can be super confusing. So let's strip away the mystery and clearly define what these things actually are. So the crucial point here is understanding the difference. A shelf company is all about its age. It's incorporated, put on a metaphorical shelf, and just left totally untouched. It's kind of like a blank piece of paper with an old date stamped on it, sold to a buyer who specifically needs an older incorporation date. But a shell company? That's defined by its complete lack of substance. It acts like a hollow box. It usually has zero physical presence beyond maybe a mailing address, and practically no independent economic value. So while every shelf company is technically a shell while it waits for a buyer, a shell company is a much, much broader category. Now, a highly publicized subset of the shell company is the SPAC, or Special Purpose Acquisition Company. You might know them as blank check companies. The mechanics are actually pretty clever. A SPAC serves as a fast-track vehicle to bring private companies to the public market, completely bypassing that rigorous traditional IPO process. The actual workflow here is fascinating to look at. Basically, a SPAC is created by a sponsor and goes public as an empty shell. It raises a massive pool of money from investors and just holds it in a trust. Then, a ticking clock begins. The SPAC usually has exactly 24 months to hunt down a promising unlisted company, often a high-potential tech firm, and merge with it. If they successfully merge within that window, boom, the target company effectively becomes a public company. Driven by sky-high investor demand and way less stringent regulatory requirements than your standard IPO, we saw an absolute explosion in SPAC popularity. Just look at that massive, towering spike leading up to 2021. Volume jumped from under $20 billion to over $100 billion in a remarkably short window. Absolutely wild. All right, Section 3, legitimate business versus red flags. Because shell companies are so heavily scrutinized, we really need to objectively separate their boring, everyday corporate uses from the sinister stuff that actually makes the headlines. This side-by-side comparison is really key. Listen, shell companies are not inherently illegal. They are perfectly legal plumbing for mundane things like holding real estate across a corporate group or acting as special purpose vehicles for a single merger. But they become incredibly dangerous when used to intentionally obscure reality. I'm talking about things like stacking entities across different jurisdictions specifically to break a financial audit trail, or just rotating money around with absolutely no clear business rationale. When banks and regulators monitor for money laundering, they aren't just taking wild guesses. They are actively hunting for these specific, documented red flags outlined by FinCEN. That's the Financial Crimes Enforcement Network. They're watching closely for wire transfers where the originators just can't be identified, payments that don't reference any actual goods, or multiple transacting businesses that bizarrely share nothing but a single registered agent's address.
And one of the main ways illicit actors trigger these red flags is through nominee services. Incorporators will often legally provide proxy services, meaning they'll provide substitute directors, stockholders, or even bank signatories. So the name you see on the public registry, it's almost never the person actually pulling the strings and moving the money. It creates this massive, opaque wall of anonymity. Which brings us to Section 4, the Global Transparency Crackdown. With literally billions of dollars at stake, let's see how this all builds into an ongoing cat and mouse game between global regulators and financial criminals. To pierce that veil of anonymity we were just talking about, financial institutions and regulators now hunt relentlessly for what they call the beneficial owner. The magic number here is 25%. Basically, a beneficial owner is generally defined as any natural person holding at least a 25% equity stake in the entity or someone who exercises substantial control over it. And you can see a clear tightening of the net over the last decade. Following the strengthened FATF standards in 2012, massive data leaks like the Panama Papers in 2016 just continually forced international bodies to revise and strengthen their anti-money laundering frameworks. This pressure led to strict rules like the EU's Fifth Anti-Money Laundering Directive and culminated in recent sweeping U.S. legislation regarding beneficial ownership information, or BOI. But honestly, here is where the story takes a fascinating turn. In a massive 2025 policy shift, the U.S. government actually rolled back reporting requirements for domestic companies. The FinCEN final rule permanently exempted all U.S. domestic reporting companies from beneficial ownership reporting. The argument? That collecting this data wouldn't serve the public interest or be highly useful to national security. Instead, they put the entire regulatory focus squarely on about 20,000 foreign entities registered in the U.S. Ironically, they're even deleting previously reported data for U.S. persons. So this leaves us navigating an incredibly complex landscape. The rules of the game are constantly shifting. We have data leaks exposing offshore secrets on one hand, yet major jurisdictions like the U.S. actively carving out massive domestic exemptions on the other. It really leaves us with one massive question. Will the anonymous shell company evolve into something entirely new, or will global pressure finally force it into extinction? And perhaps more importantly, where exactly will the next $1.3 billion ultimately be hidden? Thank you so much for joining me on this explainer. Until next time, keep questioning what's beneath the surface.